Step one is to plan your finances. Now divide this into three separate categories that are essential to setting you up for success. Those categories are your savings, your income, and your credit score. First, you primarily need to save to cover your down payment and closing costs, as well as any fees associated with getting the loan and purchasing your property. Understand though that there are a ton of loan options available that range from $0 down all the way to 20% plus. Now, your specific financial situation and how much you plan to put down will largely determine how much you need to save. As a benchmark, you should typically avoid down payment assistance programs if you can, because keep in mind, the more money that you have saved for your purchase, the better off that you'll be financially. And avoiding these programs results in a more simple and straightforward transaction. Now let's plan for an FHA loan. The usual down payment here is about 3.5%. FHA loans are great for first-time home buyers, and they are described as a home mortgage that is insured by the government and issued by a bank or other financial institution that is approved by the Federal Housing Administration. FHA loans usually require a lower minimum down payment and are less strict regarding credit scores. Remember though that the 3.5% down payment for the loan does not include your closing costs. Closing costs are fees associated with getting a loan and buying your house. Examples here are your title work and insurance, your loan fees, your prepaids for mortgage insurance, homeowners insurance, and all sorts of other costs can go into this. So it's recommended to save an extra about 3% for your closing cost. The goal is to have about 6.5% to 7% of the property purchase price saved to cover your down payment and closing costs, because keep in mind, closing costs are going to be your responsibility by default as a buyer. It's not always the case that closing costs can be negotiated to be paid for by the seller, and it's most likely that you are going to have a down payment, so it's better to just go ahead and plan for one. Now drop a comment if you need a video that covers down payment assistance programs or how to negotiate closing costs with sellers, because it is important to know your options and not get discouraged if you don't have 7% saved or if savings are hard to accumulate for you. It is still very possible to get a home this way, but this video is just focused on today's best practices. Now, regarding income, you'll want to show that you've been gainfully employed for over the last 2 years. This doesn't necessarily mean at the same job for the whole 2 years. It just means that you've had good, consistent work history, no large gaps in employment, and steady income coming in. If you haven't been working for 2 years, that can be fine as well. Things like school, apprenticeships, or trade programs can count towards that work requirement if you can show an accepted offer letter for where you were soon to be employed at. Finally, for credit score, a great benchmark is to have a 620 score or higher. A 620 score is likely to be seen as good credit for a lender. Some loan options start lower than that, but remember, the lower your score is, usually the higher interest rate that you'll have, along with potential extra fees or a higher down payment to secure the loan. For the best case scenario, aim for a 740 median credit score, as that is only going to help you out, offering you many more loan options, better terms, and a more competitive interest rate. So if you've listened to everything that I've said so far and you feel as though you're in a pretty good spot to start the home buying process, then we'll move on to step 2, hiring a realtor. This step is crucial because a good agent's going to educate, guide, and represent you in your best interest. Keep in mind that sellers will typically have their own agent to represent them, and if you want to work directly with them, that's fine, but remember that it's their job to actually negotiate against you and get the seller the best terms possible. To protect yourself and not have a trained negotiator working against you, it makes the most sense to hire a buyer's agent to represent you and you purchase a loan. This is a role that I often take with my clients, working to negotiate against all other parties and get them the best terms possible. Usually, hiring a buyer's agent will be at no cost to you because in most cases, when sellers sign a listing agreement, they agree to pay their agent a commission, and that agent will typically share that commission with the agent who brings the buyer that purchases the home. Now, this isn't always the case. For example, a for sale by owner might not have enough equity in the house to pay commissions at all, or the commission that the listing agent agreed to is too small to split. In a situation like this, you would be liable for paying your agent's commission, and it is rare, but it would be a fee that would be discussed before closing. And by having this conversation with your realtor up front during your consultation, you would know exactly what moving forward together will look like. This would also all be covered in your buyer agency agreement. Good agents will have you sign this up front to protect all parties involved in the transaction. The buyer agency agreement is a contract that legally outlines our whole relationship as realtor and client, details my expected commission, and actually hires me to represent you. We do this up front for transparency and so that everybody knows what the process looks like moving forward. When finding a great agent to help you out, you're going to want somebody who is very familiar with the neighborhoods and cities that you are interested in. as well as an agent who is familiar with the process for your specific situation. Whether that is a first-time home buyer, investing, up or downsizing, or you're a veteran. Each situation has its own nuances and utilizes a slightly different process or network, so you want to choose an agent who is skilled at handling those types of transactions. If you feel like this is a lot of information, don't stress. I've already done this part for you. If you're ready to get connected with a realtor and start the home buying process, you will actually find a link in the description of this video where if you take a moment to tell me a little about your buying timeline and what you're looking to buy, then I will make sure that you get connected with an agent just as good at explaining things as me, and they will help walk you through the home buying process in your market. And that will take us to step 3, getting pre-approved for a loan. As mentioned, there are many different loan products out there. Most lenders will oftentimes carry a majority of the loans available, VA, FHA, conventional, USDA. So you don't have to apply with multiple lenders when one can quote you for multiple products if you qualify, which is great. It is recommended that you ask your realtor if they have any lenders that they have worked with and, them and their clients have genuinely enjoyed and been happy with their services. Realtors cannot receive any kind of kickbacks from lenders for giving you a recommendation to them. It's completely illegal. So that actually makes it a great way to pick your realtor's brain and see who they have honestly enjoyed working with. These lenders are often local, making it easier to talk to them on the phone or visit their offices, which does help the transaction go by more smoothly. In addition to asking your realtor, ask your friends and family if they have any recommendations. You may also opt to work with a mortgage broker. Now, this is going to be someone who will take your application and get you the best terms possible by trying all the different lenders. This will give you a great picture of the various options available to you based on your income and credit score. And you can also try your local banks or credit unions, as they may have a niche product available for just you. Finally, you also have your massive online lenders like Quicken Loans, Rocket Mortgage, or OwnUp that you can utilize. Now, it's very important to shop around for a home loan while applying, regardless of if it's a local bank or company online. Usually you'll fill out an application form, which lenders will use to assess your financial situation. On this application form, lenders will typically want to see your most recent pay stubs, 2 years of W-2s or 1099s, 2 years of tax returns, and most recent 2 months of bank statements. Part of getting pre-approved is a hard credit check. It's essential for lenders to accurately determine your score and offer you accurate loan terms. Understand, though, that this hard inquiry may only drop your credit score by up to 5 points. It's not going to tank your score by any means. With the credit inquiry, you will actually have up to 45 days to shop around with pre-approvals with no further impact to your score, as all inquiries will be bunched together as one, allowing you to compare the rates and fees from other lenders. You could be locked into this loan for the next 30 years, so it really is wise to take the time to compare and choose a loan that you really are most comfortable with. Once this is completed, we move on to step 4. With your finished pre-approval, it's now time to start house hunting. Before you even start, you're going to want to make a wants versus needs list. With this list, you're going to want to consider the major things. Do you have a growing family? How many cars do y'all have? Do your pets need a big yard? And other things of that nature. Now, creating this list will vet so many homes so that you don't end up wasting time with, what you see in person. And the wants versus needs list will be a great tool to pass on to your realtor. Because with this list, I'll be able to see exactly what you want in a home and guide us towards the homes that are the best match for you. Now, it's easy to feel overwhelmed when you get your pre-approval letter and see 200 homes available in your area. So this list really is crucial to help make the right decision and save a ton of time by eliminating a majority of the properties available. If you and your realtor are on the same page, meaning you've had your consultation up front, you've signed your buyer agency agreement, you've gone through the loan process, you've gotten pre-approved, and you have your wants versus needs list completed, then it actually doesn't take much time to find the home that's the perfect match for you. The goal here is to be as strategic as possible and not distract yourself by looking at homes that aren't a candidate to be a perfect fit or homes that are over budget. Once you've found that perfect property, we actually move on to step 5, placing an offer. At this step, it's important to remember it's no pressure, but time is of the essence. I've seen and sold many homes where someone wants to sleep on it or think it over and it's a perfect match, and that house actually goes under contract that night. So try and make the decision on placing an offer as soon as possible, because there are likely going to be multiple buyers looking at the same property that you are. Now that you have the perfect home and decided to place an offer, understand that there are so many different terms that actually go into the offer letter. Comment if you need me to make a video breaking down how to write a winning offer and the terms included. But for time's sake regarding this video, you're going to ask your realtor to help you understand the terms and conditions of the offer that you're placing. Now, when the offer is submitted to the seller, industry standard in Maryland is to hear a response back in about 24 to 72 hours. And depending on the response, will determine how we move forward. Typically, sellers will choose either one of these three ways to respond. One, they can accept the offer on your terms, which is the best case scenario. Two, they can flat out reject the offer. They don't have to offer a reason, it's just rejected. Or three, they can counter your terms, which is basically them saying, we like a majority of your offer, but can we change this or can we change that? An example would be, we like your offer, can we just close a week later? Now, if you do get a counter, you have the ability to agree to that offer, then you are ratified and under contract. Or you can reject it with no explanation needed and just move on to a different property. Or you can counter their counter until you two have terms that you're both comfortable with, excited, and happy about moving forward with. Now, once the contract is signed by all parties and ratified, you then move on to step 6, your due diligence period. When buying a house, you have a due diligence period, which is an agreed upon time frame of which you have the opportunity to perform any inspections that you feel as though are necessary. You will deposit your earnest money check, which is between 1 to 3% of the purchase price, and that goes towards your down payment and closing costs. And you're also going to want to get your homeowner's insurance around this time as well. The home inspection is typically one of your only out-of-pocket costs during this process, and it will be about $400 to $700 depending on what you want to have inspected. Structural, wood destroying insects, mold, and radon are just a few of the inspections that you'll want to consider. The inspector is going to go through the entire house, in the crawl space, in the attic, on the roof, and ultimately create a report for you that details the health of the property in question. Keep in mind, there is no pass or fail regarding the inspection. Now, you may have a more lengthy report with more issues or items to note, but it will be up to you to move forward with that property or to negotiate repairs with the seller. Additionally, this is going to be where you're going to want to get your homeowner's insurance to protect your investment, but the lender is also going to require that you get it as well. Make sure that you shop around so that you get the best quote, and also ask your realtor for a recommendation like you did for the lender, because some properties, depending on location, may require additional insurances such as flood, fire, hurricane, or earthquake. Now, after your due diligence period and review of inspections, you will decide how you want to move forward and ultimately land on step 7, negotiating repairs. Now, unless your offer stated that you were going to purchase the property as is, then you should have the ability to negotiate repairs with the seller. Any item that is not operating properly or in functioning order are warranted and completely fair to ask for. Once you submit your list of repairs, they're going to review your request, and similar to your original offer, they will have a few options to pick from. The sellers can accept your request, which is them saying, yes, we'll go ahead and address all the repairs that you've mentioned by either seller concession offered towards closing costs or by hiring a contractor to fix the issues for you. The sellers may also just deny the request, which is simply, nope, sorry, we're not doing any repairs here, which it's kind of unlikely to happen because most sellers will be reasonable about reasonable things. So don't stress too much about this, but it is possible nonetheless. And option 3, other sellers may have a counter offer for you, which is, yeah, we'll fix this and that, but not those. And you all can go back and forth until, you land on something that works for everybody, leaving all parties feeling comfortable, excited, and happy about moving forward with the transaction. Once repairs and how to move forward have been agreed upon, we then move on to step 8, the appraisal. The appraisal will be ordered by the bank. The appraisal is to protect the banks, and it's not often a good determination of the actual market value of the property, but it is to give the bank a good idea of how much money that they can safely lend you based on the appraiser's value of the home. The bank is not going to lend you more money than what the appraiser deems the home is worth. Now, appraisal reports can come back in one of 3 ways. The house can appraise at the value or price that you are under contract for. Now, that looks like your offer being $300,000 and the appraisal value coming back at $300,000. With this, you can just continue the transaction. There is no bump in the road for this step, and you're pretty free and clear. Option 2 would be that the house can appraise at a value higher than the agreed upon sales price. If this happens, it's great because it could mean that you potentially have some built-in equity into your soon-to-be new home. Depending on what that value comes back as, you may also have the ability to negotiate some extra closing costs with your lender or things of that nature. And option 3 would be the appraisal coming back at a value under what you're under contract for. Example is the price that you agreed on is $300,000 and the appraisal value is $295,000. Now, if this happens, you may need to either pay out of pocket that difference, which in this case would be $5,000, or renegotiate the contract and have the sellers come down on their sales price to the appraised value so that the transaction can keep going. Oftentimes, this is the approach because really people don't try to work so hard against the other party in these real estate transactions because we all have the similar interest of getting to the finish line. There may be situations where the seller can't come down in value and you would have to pay that difference during closing. Keep in mind that with appraisals, depending on the loan type and condition of the property, appraisers may have specific notes and repairs of their own that need to be taken care of prior to closing. This is mainly seen with VA and FHA loans because they're more strict with the health requirements and safety standards that the appraisers are looking for. Because of the more strict standards, loan products like VA and FHA typically only go with homes that are in good livable condition. These loan products are not made for big fixer-uppers or investment. The home has to be in good condition, meaning like it has to have all the necessary basic appliances, no holes in the walls, no cracked windows, no pulled back carpet, and like necessary handrail placement where there are stairs at. So if the appraisal comes back at the value that you're under contract for, but items like that were noted, then you will have no option but to get those fixed before going to closing. Typically, your agent will get the appraisal report back to you, and you two will send it to the seller side, and they will hire a contractor to make those repairs. Then before closing, the appraiser will be back out to check the work has been done properly and give the bank the all clear for lending you the money. This situation doesn't always happen, but just beware that it's possible in case you push the limits on the condition of the property that you're interested in. Now that the appraisal is finished and all necessary repairs are completed, we move on to step 9, the final walkthrough. This final walkthrough is going to serve as your opportunity before closing, where you get to go back into the house and check to see that the house is in the same condition as when you first went under contract and the condition that you're expecting it to be during closing. This final walkthrough is usually done 1 to 3 days before closing. Additionally, you're going to want to check that all the repairs that you negotiated have been properly completed. For that, you may either want to check them yourself, request receipts to see that the work was done, or have your home inspectors come back out at a discounted rate and just check all those items to make sure that they've been properly addressed. Keep in mind that if you're going to ask for receipts, it's better to have your realtor incorporate that request into your original repair request so that the sellers aren't frantically trying to track down receipts after the fact. If they know up front, it would just be way easier for them to provide those to you. The walkthrough is completed. Now that everything is still good, everybody's still excited about the transaction. Around this time, you'll be getting your clear to close from your lender and your closing disclosures. The closing disclosures are all of your final loan numbers, your actual interest rate, your actual loan amount, and your cash to close, meaning all the money that you'll need to bring with you to step 10, closing. Now, before signing off and taking the keys to your property, just double check that all the numbers are correct. Nothing should be unexpected at this point, and make sure that you have your cash to close amount covered. There are usually 2 ways to do this, and those would be a cashier's check or a prepaid wire transfer. Either or would be made out to the title company that is holding your funds for them to disperse. But always follow the instructions that the title company provides you because everybody has a slightly different system. Now, on closing day, you may need to be present unless you've opted to do a virtual close, and you would also need any co-borrowers or spouses that are on the loan present for signing as well. Don't forget your photo ID, and remember that this is a great opportunity to ask your realtor, closer, and lender any questions that you may have. Once you're done signing, that's it. You're now officially a homeowner. If you were my client and this was like a consultation, I would go ahead and plan 3 to 6 months to get through all those steps so that you aren't under very stressful time constraints. Things can always be moved up or back if needed, but giving yourself ample time is only going to help. If you just want a more personalized approach, go ahead and actually schedule a time to speak with me through the links in the description so we can actually strategize on how to directly help you take the next steps and achieve your goals. Until next time, y'all, my name is Luther Williams. Thanks for watching.